Welcome. Now, what I want to do is I want to explain to you the borrowing cost, but the change in policy, right? There are only two ways in terms of which you can deal with a change in policy in borrowing cost. One, a company, you find that the company maybe is expensing, right? Let's say your interest expense is 100,000. Then your interest capitalized, let's say it's 70,000, right? That will leave you with finance charges of 30,000. Now, the first thing that you must identify is that you were sitting here. All along, you were putting an expense of 100,000. But because you are changing from expensing to capitalization. Now, what is capitalization? Capitalization means we are moving out interest out of the income statement to where? To the balance sheet. Now, so in short, if you're expensing, now you're capitalizing, meaning you're expensing, you're moving to capitalizing. When you're expensing, you'll be here. But once you change to capitalizing, you'll be here. Because this 70 is going to move out of this account and go to balance sheet. Now, what will happen in PPE? PPE will increase by 70. Right. Now, what are the changes that we are going to have in your income statement? We're going to have a decrease in finance charges. Some of you can say interest expense of how much? 70,000. Because it's going to decrease from here to here. Okay. Then if you decrease an expense, the profit will increase and then the tax will increase. Increase in tax. Let's assume 30%, okay? At 30%, 7, 14, 21, 21,000. Right. That will give us a net increase in profit. Now I'm talking about income statement here, right? 70 minus 21, 49. Okay. Now, since that is the situation, remember, this is the income statement situation, this one. All right. But if you look at this side here, if you had 100, they tell you now that you must capitalize 70. You are moving from expensing to capitalizing. You minus 70, it takes you to 30. So your finance charges have decreased by 70, meaning the expense called finance charges decreased by 70. If expenses decrease, profit goes up. If profit goes up, the tax will increase. Then that will be a net increase in profit. Now, how will this affect the balance sheet? The balance sheet, PPE, will increase. Let me say increase in PPE. It will increase by how much? 70,000. Remember, what is capitalization? If you move this amount out, if you decrease your expenses from 100 to 30 by this amount moves out of the income statement. Then it goes to the balance sheet. Here it is. It will increase PPE. Right. Then, once PPE has increased, that will also increase your tax payable. I'm just demonstrating this thing with 1 year. Right. And then we'll have a retained earnings, an increase in retained earnings. Right, that increase will be 49. Right. Now, when you are expensing, you are moving from expensing to capitalization. The direction you are going to take for all the years is this one. What you are seeing on this side on your this is the direction you are going to take if you are moving from expensing to capitalization. It's not going to change this direction. It will be a decrease on all the years, increase just like that. The direction doesn't change because you're expensing to capitalization. Okay, if you are doing that. Now let's deal with this situation if we move to the situation of capitalizing. If you are capitalizing, now you want to expense. What it means your finance charges will start at 30,000. That is your starting point, right? Now, because you are capitalizing, now you want to expense. It means you are going to bring back the interest capitalized into the books. You're bringing back the interest capitalized here, and that will take this to let me just do it like this so that we don't get right, so I don't get confused. So your finance charges will be 100,000 now. Now, this is what is happening. Right, this is what is happening now. So you were here, all along you were here. Then your expenses, because you were capitalizing, you are bringing it back. It's like you're taking this amount, you are pushing it back into the income statement here. Right. So what then will happen is your expenses was 30. By bringing back the amount that is sitting in PPE to here, you've increased your expenses in the income statement. So what will be the direction? Increase in finance charges, 70,000. Right. Then followed by, if you increase expenses, the profit decreases. If the profit decreases, the tax will decrease. You decrease in tax, it's income tax expense. Let me just say so. It's decrease in income tax expense. It's the same thing even at the top, so that people can understand that here we are talking about income statement. Increase in income tax expense. Right. Now, here you've got 70 increase, then you'll have a decrease in income tax of 21, giving us a decrease in profits of 49. Right. Then we come to this one. Remember, if you're taking this 70 and you're putting it back here, your PPE will decrease in PPE of 70,000, and then that will be coupled with if this one is decreasing here, then it will automatically decrease in tax payable of 21. That resulting in a decrease in retained earnings. So now what I was showing you is the direction. If you're expensing and you are changing from expensing, you're moving to capitalization, what will happen is you had 100, you are moving 70 out, you're going to put it here in the balance sheet. That leaves you with 30 at the end. So you are decreasing your financials by 70. If you decrease expenses, profit goes up. If profit goes up, the tax goes up, and then it's a net amount. Since I'm moving this amount from the income statement to the balance sheet here, the increase in tax expense will increase the tax payable, resulting in an increase in retained earnings, right? But now what happens if you were capitalizing? We are moving from capitalizing to expensing. So you're starting here, and then you move this amount that is sitting here, you move it back because you were capitalizing, now you're expensing. You move it back to here, it takes you to 100. So what have you done? You've increased expenses by 70. If you increase expenses, the profit decreases. The profit decrease, the income tax will decrease. Then there's a net decrease in. So since if the amount was sitting here and you move it out of here, it decreases PPE. So it's a decrease in PPE that will result in a decrease in tax payable, then a decrease in retained earnings. This one reacts because of this one here, right? So these are the two directions you can have in a change in policy when it comes to borrowing cost. These are the two. You can't have anything more than this. So when reading a question, you must just identify whether are you sitting in number 1 or are you sitting in number 2. Okay, that is what you need to do. So let's then go and check a question here that I've given you. Let's see, it should be this one, yeah. Now, here's the question. It's on page 21 of that handout that I gave you on borrowing cost. It says, during the year, we are reading here, with regard to borrowing costs from capitalizing. It's from capitalization. So you were capitalizing, now you are moving to benchmark. Benchmark is expensing. Benchmark is expensing. So what is your expectation? I'm expecting that if I was capitalizing, I'm moving to I'm moving to expensing, which is this situation. So my expectation is that my finance charges must increase, income tax must decrease, then I will left with a net decrease. My PPE must decrease. This must decrease the tax payable. Then there must be a decrease in retained earnings. Okay, right. That is my expectation in terms of that exercise. Now, if I then basically take a note of that, which is here, right? Then my view is that that direction that we spoke about should be the one that we follow. Now, so if I was capitalizing, these are the amounts that I've been transferring out of the income statement to to the balance sheet. I've transferred those amounts. So currently in the income statement, I'm sitting with these amounts here. Right. So I must bring back the top ones here. If I, for an example, if I'm sitting with 240 currently in the income statement, when I bring back 160, it means that I should be in 2010, my new figure in the income statement should be 400,000. My new figure in the income statement should be 400,000 because I'm sitting with 240. If I take out this amount from the balance sheet and I put it in the income statement, it increases my expenses to 400,000. Right. Let's then now look at the calculation itself. Right. What am I going to do? Remember these amounts, like here, you see, it's 160 that I'm going to move from the income statement, like I said here. Right, like I said here, I'm sitting at 240. If I bring the 160 in this, it will take my figure to 400,000. Right, and you can see here that if you look at these figures here, this 200,000 in finance charges and the 200,000, they are these ones. It's these two that are in this extract here. See the 200,000 finance charges here. They are these two. So currently you are sitting with this, but you are going to bring back 110 and 168 from the income, so from the balance sheet to the income statement. Right. So your movement in 2010, for an example, you are sitting at 240, but you'll end up at 400. How much is the difference between 240 and 400? 240 minus 400, that gives me 160. So these ones here are the movements at the top because are the ones that are going to change your finance charges. Now look at the calculation. What will happen in 2010? Increase your expenses, decrease the tax, then that's a net decrease. What will happen with assets? Decrease assets by 160, decrease the tax liability. Okay, now obviously if you go on now, let's look at just the income statement. The income statement will increase by 110, decrease the tax, then it's a net decrease. The direction is not changing. The direction is the same, it's not changing. Now obviously if you've got 48 here plus 33, must give you this one here. Right, must give you that one. Right, so you go on here, it's 168, the increase is 50. So this 50 plus this 81 here must give me this one here, the 131, 400. 81 plus 50, 400, this is it gives. So the direction is not changing. You can see it's a decrease in assets, it's an increase in finance charges, just like we expected here when I showed you this thing, that if I'm moving capital, it must be an increase in this, a decrease in that. All the direction that we are seeing here will always be the same all throughout. Right, so this is the situation. Right, this one I've already showed you several times how to calculate that to get the opening retained earnings in the statement of change in equity. So that is the movement you are going to face. Now let's then now deal with the exercise itself. You'll see here. Now if I've got 200,000 here and I've got 200,000 here, when I bring 168 into the income statement and I bring 110 into the income statement, they are going to add on those 200. The other one will be 368, the other one will be 310. You see, this one, if I add the 200 here, if I add this 168 here, it will be 368. If I add the 110 to the 200 in 2011, it will be 310. Let's check. There we go. 368, 310. Right. Now let's then simplify this thing this way because it's not something difficult. Let's take, I'll demonstrate with 2012. If I'm bringing 168 into expenses, I'm increasing expenses by 168. Okay. If expenses increases, the profit will decrease. If the profit decreases, the tax must decrease. 168 times 30%. So it's 50,400. So expenses go up, profit decreases. If profit decreases, the tax must decrease. See this tax, it must decrease by 30% of this. 30% of 168 is 50,400, right? Let's minus 50,400 from 135. 50,400 minus 135, it gives me 84,600. There we go. You see. Right. You can do the same thing with 2011. You'll see it gives you the same thing, because if I've got 200 here and I add the 110, it takes me to 310. If the expenses increases by 110, the profit will decrease by 110, and then the tax must decrease by 30% of 110, which is 33. Now, if I take the tax, which is this one, now be careful, there's a loss in that here. If I take the text there that is written at 120, be careful because there's a loss there, right? So you must be careful, because you need to add because of that situation of being a loss. You see the 120 is not positive, so it's 33,000 at the 120, which is an asset loss. That will increase that amount to take you to 153. Okay, just be careful in that exercise because that's a loss. Now, I did show you in the other example that you must firstly calculate these two figures here. You must calculate them first, and the calculation is this one here, right, to get to those figures there. Right. Now, how then do you put this restatement, this one and this one? I've said, if you are in 2011, if I'm here, I will ask myself, how many priors do I have? I only have 2010 if I'm there. What is the net here? I'm asking about this one here. 112 decrease in profit. It's a decrease of 112 in profit. You see, it's a minus. It's a decrease also, right? When I'm here, how many priors do I have? I've got 2011, I've got 2012, right? I've got 2011 and I've got, 2011 and 2010. 2011 and 2010 here. 77 plus 112, it's 189, but it's a decrease, right? 189 decrease. You see, it's a decrease of 189. So in the block, you can minus the 2, they will give you this one. And even on the other side, you can do the same. The figures that you are reading from here, they come from here after having adjusted. And this one is here. Then you've got your dividends below there. Now, then you need to now deal with this situation. Remember I said to you, this thing comes directly from the question. You must tell us what is it that happened. I've changed from capitalizing to expensing. The reason is that I want to have reliable and more relevant financing information. The change in accounting policy was accounted retrospectively, and comparative amounts have been appropriately restated. You start by telling us that. And then after, it's very important that you do this. You give us the description of what do we see this side is what we have described here. So I know if I'm looking at 110, here, the 110, it's an increase in an expense. This one is a decrease in an expense, giving me a net according to this description, right? The net of 7, which is a decrease, right? Now you'll notice that also when you're looking at this thing, this is a direct transfer of the figures that you see here. 168 increase in and 110. Then you bring them here. The tax is it's a decrease of 40, and you bring them here. The net is the 117,600, here it is. Right. In terms of the assets here, remember this movement happens cumulatively, okay? So you started at 160. 160 plus 110, the movement, gives you 270, this one, okay, which is the 270 that you see here, right? So 270 plus 168, 270 plus 168 is 438, which is this one, okay. So here it is, right? So it's just, these figures are cumulatively, okay, because in effect you are taking them from here. They're cumulative. 160 is 160 plus 160 plus 110 is 270, right? 270 plus 168 is this one, okay. It's the same thing that you were doing even here, okay, because 48 is 48 plus 33 it's 81 plus 50 it's 131 400, okay. So you transfer the figures to here, the 81 and 131, here they are. The net, now I've got a bracket, the y. Let's see first. It's decreasing. All of those figures, there should be a decrease. Decrease in equity. Okay, this should not be a bracket here. Right, it's fine. So here, there should not be a bracket. I was just removing it. So 112 plus 77. Right. So you see here, 112 plus 77 will give you the 189. Right, 189 plus 117, 600. 189 plus 117, 600. 306, 600. Here it is. Right. Then you must always show us this amount, adjustment, meaning the amount that you are using to adjust retained earnings in 2011, which is this one here, which ties to what you see also here. Right, it ties to what you see also there. So your change in policy becomes that you are going to disclose it in that fashion. You can see that even the top part is more or less the same as what you see in the other change in policy of inventory. Okay, this one, the easy part about it is that it takes one direction. It doesn't change the direction. If it's going up, it goes up forever. Right. All right. Here it was capitalization to expensing. Now let's look at this one. It says during the year the directors adopt alternative for borrowing cost to capitalize borrowing cost. So now here you were expensing, you wanna now capitalize. Now here it is. You're expensing, you want to capitalize. So here's the direction. So finance charges must decrease. Finance charges must decrease. There must be an increase in tax and net, and then increase in PPE, increase in tax payable, increase in, that's the direction it will take. It will always go like that. Now let's then check. Here we go. Right, let's analyze the question. Here is the question. So you were capitalizing, decided to adopt an alternative for borrowing cost and to capitalize borrowing cost on qualifying assets. So no, you were expensing here. Expensing, now we are capitalizing. So if you are sitting, for an example, with 29 while you're expensing, you must move 20 out. It will leave you with 9. It will leave you with 9, isn't it? The balance will be 9 because 29 minus 20 leaves you with 9. So what you then need to be careful of is that once you're capitalizing, your expenses will go down, but your PPE in the balance sheet will go up. Okay. Right. Let's then check. Here's the calculation. Let's start. You see here, you were sitting at 29. You will end up with 9. So your movement is a decrease in finance charges. Here are the figures that are decreasing in finance charges. Okay, they are decreasing your finance charges because you are moving 20 out. That leaves you with 9 and 38 500. So if expenses decrease, profits will increase. If profit increases, the tax will increase, and that leaves you with a net for the year. Right. Now, what we didn't basically do in this exercise is to do to do the balance sheet part. But okay, let's try and analyze the balance sheet part. Let's start again. Let's see. Let me move this calculation like this so you can see what we are doing. If I look at this thing very well, I just want to make sure. Yeah, right. So if I'm decreasing here, remember, I'm going to move. I had 29. I'm moving this amount out to the balance sheet. Okay, right. Now, obviously, that means it will increase PPE, isn't it? So now, but you have to start at 2010. 2010 PPE will increase by 17. 17, then plus another 17, that should be 34,500. 34,500 plus 20 is 54,500. Right, let's just double check. 17,500. Right, that's 54. Okay. What then will happen to tax? Increase in tax payable. I will start here with the tax increasing is 5.1, which is this one here. Right. Then there's another 5.2. So 5.1 plus 5.2, 5.250 plus 5.1, it's 10,350. I'm adding the two figures here. Okay. Right. When I come here, I'll just take the 10,352 and plus 6. So it gives me 16,350. And that is an increase in retained earnings. Okay. The increase in retained earnings is 11,900. Then I'll add the 2 after it. There's 2. 12250 plus 11,900. That gives me 24,150 plus 14,000, which is this one. From the 24,950 plus 14,000, that will give me 38,150. So that is how it will react in your balance sheet. Right. Now, let's then get to this. I've showed you before. So you just need to find a way around it. Now, let's then get to use this calculation into the question. Right. So here you are given profits and the likes. Okay, profits. So now, what happens if you do this in this way? Right. All right. Now, if you look at this, it says you'll see here. It says profits are at the 20,017. Now, if you decrease expenses, profit goes up, right? Isn't it? You'll see here. If you decrease expenses, then the profit will increase. You'll see it increase by 20 and 17. And those are the adjustments that you see here in the equation here. Those are the adjustments. And if you increase profits there, tax must also follow suit. For an example, if you take 30% of 20,000, it's 6, which is this one. The tax is increasing. You do the same with the 17. If the profit increases, the tax will increase. Okay. Now, then you will need to get to the space of the statement of change in equity. Already you must firstly calculate these two. You should know by now. Now, the rule is simple. If I want to adjust with this figure, I will say, how many priors do I have? I have 1. What is the net? Here is the net. Then the next year, how many priors do I have? 2. This 11 plus this 12 should adjust 2012. 12250 plus 11 900. That should be 24 150. Here we go, 24 150, because you've got two priors, you've got 2011 and 2010. You adjust there. Then the profits obviously will come from here. These ones, these two will come from here. They're here. Then we've got the dividends declared. Right, so you've got your changes in equity. Then after that, you deal with this change in accounting policy. Here's the note and the reason. And you tell us that the change was accounted for retrospectively. Comparative amounts have been appropriately restated. Okay, so then you disclose this calculation here that you see here. This calculation that you see here, you transfer the figures to the top part here, right? So you've got a decrease in expenses on both years. You see the direction is the same. Increase in tax, giving us a net increase in profits. Then you come here, it tells you that you've got 34 as an increase and 54,500 as an increase, which these figures come from here. Right, you've got a tax that is increasing, you've got a net amount that is increasing, which are the figures that you are disclosing here. Right, then you've got, if your expenses are decreasing, the profit will increase. If the profit increases, that's an increase in retained earnings as defined here. Right, the adjustment against the retained earnings at the beginning of 2011, which is this one, it tells you it agrees to what you see here. Right, in the 11 here. Now, some of you will say, why is this figure now in a bracket? Because it's defined here as increase in equity in a bracket, and increase is in a bracket, so it's an increase. Like you are saying here, it is increasing here. Right, so this one is a change in policy where you are capitalizing now. All along you were expensing, but now it decided that you're going to capitalize. So it is very important to understand that the direction that is taken here in number 1 and number 2 will always remain the same until the end, when we are dealing with a change in policy that relates to borrowing cost. Thank you.